April the 5th, Wednesday. I'm delighted today to be joined by Rustin Edwards, Head of Fuel Oil Procurement at Euronav, Maliha Bengali, Founder, MB Commodity Corner, and Daniel Richards, MENA Economist at Emirates NBD here in Dubai. Thanks a lot for joining us, everyone. Great to see you all. Maliha, let's start with you, please, to get a bit of a synopsis from you on the financial sector. You know, we've had what happened in last month in March, the SVB, etc. Sort of bank run, I suppose, in the US regional banking system. Bit of information from the Fed recently. Sounds that all looks a bit stable. Give us your synopsis of what we expect for the second quarter, Fed policy point of view, and have we lost the nervousness in the market from what we saw in the banking crisis?
Sure. Thank you very much. In terms of the US regional banking crisis, I mean, a lot of people are trying to look at that and corroborate what happened in 2008. And I think it's important to distinguish that this is not like 2008. This is an issue with the US regional banking where the banks took an inordinate amount of risk and they had assets and liabilities mismatched. Having said that, the Fed has put some measures in place to sort of secure, sort of plug the leak in the US regional banking. I don't think the crisis is over yet, but it's not about going to filter into the European sector. There's another bigger problem that's emanating is in terms of mark-to-market risks. A lot of these banks have exposure to commercial real estate, residential real estate mortgages. So as the consumer weakens and the market weakens, there's still a lot of concern, and going back to Credit Suisse, as to what assets are actually on these banks and how much are they actually worth. So it's not a question of banks having bad assets, it's about really, really badly mispriced. And we really don't know how far that can go because as rates go up, these assets get marked lower. Moving aside from that, there's another problem. You know, the banking crisis was never about the cycle. It's about basically a massive slowdown in growth. Now, we've seen growth falling. We saw the ISM numbers yesterday. The data is really getting worse across the board. Even though China is trying to support the market by adding a bit of liquidity, they're not enough to save the entire market from actually going to recession. The data is very recessionary. Having said that, inflation is, coming off right now, but the core preferred measure is about 4.5% year-over-year inflation for the Fed. So the Fed really wants to be able to help the market, but they're unable to do so. And the equity market is pretty much hoping that the Fed cuts immediately, but they cannot. And we've said this for the last 7 to 8 months. The Fed is in a catch-22, where if they cut right now, we'll be having inflation for years to come, and they can never get out of that. So they have this sort of sweet spot where they're hoping that the data comes down fast enough where they can actually support the market second half of this year. But right now, there's so much volatility in terms of assets, not even banks, but also just in cyclicals, manufacturing, all of those sectors are showing weakness right now. And I think that's where the market is. So we have the Fed in May, we'll start, the market's pricing in about probably 80% chance of a 25 basis points increase, but they need to keep raising rates, and we need to see the effect of those rates impacting the slowdown. The OPEC decision obviously came as a bit of got the market blindsided it because, the market was sort of weakening and taking the excess demand out to support the markets. And, we were having a surplus of roughly 1.5 million barrels, and OPEC came and cut exactly that amount to support the market. So it's interesting how they're sort of catching up to that surplus and making sure the market's balanced, which is interesting because that actually works against the market, against the Fed, because if oil prices are not allowed to naturally fall, inflation can be higher, making the Fed's job difficult. So it's not as simple as people think in terms of, the Fed's going to cut and save us. They cannot.
Yeah, and as you said, it complicates the Fed's and the US's case on the Fed policy side and on the oil price side, of course, which they're trying to keep things under control. We just saw that survey question result that was, would that cut scare the shorts out of the market, i.e., are we going to see a continuous sort of support to prices? Rustin, let me go to you on that. A little bit about the OPEC plus surprise. I think it's fair to say that most people were surprised, apart from OPEC themselves, with the timing of that announcement. But from the shipping sector and from your point of view, are OPEC really calling it right? I.e., have people been over predicting this demand recovery that we've been expecting, the second quarter onwards?
Well, I mean, I've always been a proponent that the estimates of Chinese growth are probably greatly exaggerated. I mean, if you look at the data that's come in, OPEC cutting what they've done, they are trying to preempt a slowdown. Looking at the manufacturing PMI data across the board from China to the United States has all shown a contraction in manufacturing, while growth in service sector. When you have a contraction in manufacturing, that means your overall energy demand drops because it's far more energy intensive than the service sector is. And so with that in mind, I mean, you can see why OPEC had to do something preemptively, because the tea leaves are not coming in so auspicious for a forward rally in prices. But you know, as Mihaela says, it's basically exasperated the situation and accelerated any type of recessionary pressure that's in the marketplace now, because now you've got increasing energy prices on top of slowing economic growth, which is truly a big negative to the whole market in general. I mean, so with the increasing in energy prices, that is going to eventually roll into poor inflation, because it does take about 6 to 8 week lag for that data to start feeding in as people's supply chains start adjusting to the new pricing regime. But we've seen energy demand in the United States has not been very robust. If you look at Q1 gasoline, jet, and diesel consumption, it's well below from where it was in 2017 to 2019, anywhere between 6 to 10% lower. So it tells you that the U.S. consumers aren't out there buying fuel and move, despite what inventory levels might show you in the marketplace.
Okay, Daniel, let's go to you and give us your perspective of why you think the Gulf countries, essentially, and led by Saudi, did this. Yes, they want higher oil prices. They want to support what looked like, a weakening situation on the price front. But give us the Gulf perspective and the financial perspective of that, maybe from your point of view.
Yeah, sure. I mean, as we always say, they're trying to strip out what we call excess volatility, but only seems to be volatility on the downside that's ever really the key issue that they want to control. There's never this search to control volatility on the way up. So, while they're saying that the price of oil is going to be irrelevant to them soon from some Saudi officials, obviously that is not the case yet. And I think obviously it comes down to prices, and that is. These cuts are there to put a floor under those prices. We're not really convinced it was necessary. That kind of volatility we saw in the wake of SVB and then Credit Suisse and the rest of it, that did see a sharp fall in the oil prices, TI in particular, dropping down to significant lows. But they were starting to come back as that volatility or those concerns around the banking sector was starting to ease off. And even if a Chinese recovery through H2, there is weakness there, granted, and the US as well is starting to look a bit weaker now than that gravity-defying start of the year is starting to come off the boil somewhat. But nevertheless, we still see market tightness in the second half of the year, and this will exacerbate that. And like everyone's been saying already, that will. It's going to make central banks' jobs much harder for the second half of the year. For local economies, the inflationary impact will boost inflation here in the UAE, not so much in Saudi Arabia, but it will cut real growth. We are revising down our growth forecast on the back of this, and also for budget surpluses. We now expect a balanced budget for Saudi Arabia as opposed to a modest surplus previously. So there are implications. We're still kind of digesting and adjusting our forecast, but for Saudi Arabia, we're going to revise down our growth forecast by a whole percentage point to 2.1% this year. Essentially on the back of this cut. We still expect robust non-oil growth. The PMI survey that came out this morning underscored that. But this will weigh on headline growth.
Okay, Maliha, Rustin referred to the fact that and he's always said on this program that this whole sort of sentiment of China will save the energy markets as soon as now. But let's talk about the second half of the year. Is there still a hesitancy, that growing hesitancy, or not hesitancy, sort of, I suppose, doubt that China will be as strong as people were expecting in the second half of this year? You've got that, and you've got the West, of course, the Western economies that you've mentioned. And of course, China depends on that as well, doesn't it, from an exporting perspective. But what is the sort of progress that you're seeing from Asian demand? You've got India, you've got China, and some other economies as well. And will we see those pull that scenario upwards?
That's a very good question. I think the perception of the market, not only in Chinese demand across the board in equities as an asset class, you have this magical V-shaped recovery in earnings across the board. So we expect we have a recession in the first half and magically we recover back up. It doesn't work that way. This is not like a simple 2018 scenario. We have an economic recession. So the Chinese demand numbers in the first half of this year, China's been very clever in terms of injecting liquidity to support the housing market, and they inject sort of dribs and drabs of yuan. That sort of helps the market to rally on the financial side, but we don't see a pickup in physical flows. So market has a perception of a rally, but then it gets fizzles out. The same thing is for the second half of this year. Yes, they expect to have a recovery, but that depends on a US and European-led recovery as well. If the global economy is in a recession, which we think it will be, I think it makes it very hard for China to grow out of it. And also China's growth is not as infrastructure and growth led. It's more domestic consumer. They're really focusing on the domestic consumption. We saw last year the LNG imports are slightly going down. They're focusing more on domestic production. So they're thinking about how to make it better for the Chinese people. It's not so much as about, you know, international growth as such. So yes, the demand picture looks a bit bleak. I think the expectations are very positive. So there's some room for disappointment. And the market right now is trying to look past all of that, hoping the Fed magically sort of saves the day and they cut rate. We are now desperately hoping for a cut to play the market. And I think that's a very precarious situation, because going back to 2001, the Fed cut many times, the market fell a lot more before we actually rallied, because when they cut means that there's an actual problem. And going back to OPEC, one can also sort of surmise that if they cut right now, they're seeing something that probably doesn't look very good for them. So why did they cut so preemptively? I think demand is a lot weaker than people expect it to be.
Yeah, and yet we have a headline today on our bulletin there, which says that Saudi Arabia might raise May crude prices to Asia again. So it's kind of putting the pressure there on Asia. And we had a few comments yesterday that, you know, China will stop buying at some point if prices do go up much further. Rustin, let's go to you and get a bit of a picture of where products are at the moment. We're now at the start of Q2. The product sanctions or price cap is well into being exercised since mid-February, or since early February. So we're 2 months into that. What are we seeing there in terms of Russian flow impact? And are we, you know, and if you can just address also jet fuel, are we seeing any support there from China's reopening last month to foreign tourism, etc.? And I mean, I was in Europe a week ago in France. You know, a lot of tourists there, much earlier than I would have expected ahead of the summer, you know, post-COVID kind of like pent-up demand. And so what are we seeing, the impact on products because of that?
Well, there has been a general increase in jet demand because, okay, yes, people have disposable income in Asia and they're trying to get out because now they can travel a bit more freely. So there has been an increase in jet demand. The interesting thing, though, is that product cracks in general for distillates have been coming off. Despite even the refinery strikes in France and the, you know, roughly 800,000 barrels a day of refinery shut-ins that have been going off and on over the last 3 weeks now. You know, we are seeing weakness in the distillate cracks, and we're also seeing weakness in other industrial fuels as well. You know, VLSFO, which is the main fuel for ships, is down massively from where it was a week ago, mainly on the back of higher supply and weaker bunker demand, which then translates into economic growth, economic activity. And road fuel demand is doing okay, but it's not going robust. I mean, I think you'll see even with this springtime, you know, we've got Easter holidays here in Europe. They started this week for most of the northern European countries. You know, they start for some of the southern countries coming into the Good Friday holiday on this Friday. So there will be some tourist demand that picks up because that's, you know, general people want to get out and relax. But it is a case that, yes, we are seeing a bit more increase in demand in that. But is it enough to tip the scales? Don't know yet. Haven't seen it happen.
Maniha, what about, let's talk a bit about US production. There's been a bit more sort of positive sentiment around that, you know, we're going to actually finally see some traction there of more US oil this year. I mean, I don't know if I haven't actually followed the numbers specifically, but there have been a few headlines recently that is going to happen where else it didn't last. Is there any feeling of that? And, you know, in terms of also supply to Europe, if you like, in terms of more fallout from Russian sanctions later on in the year and a tighter demand situation?
It's a very good question, because all of last year, we've been waiting for US domestic production to pick up. I think we've got to 12.3 million barrels per day. We're still shy of where we were before the crisis started. US producers are very shy to increasing the production because they know that, you know, with all these clean energy transmission policies, you know, they're getting this risk tapped effectively. Why would they invest in future capex? And that's been pretty much the biggest bull case, right? The lack of energy investment on the capex side leads to a supply shortfall for years to come on the US side. So you need to incentivize these producers. And we know the US White House had a plan to rebuy all the oil they sold back to the US Strategic Petroleum Reserve. And the White House has been sort of faffing about in terms of when they're going to be getting in. And that's actually another reason why we think OPEC may have cut, because they pretty much deny that, we might delay the purchase till the end of this year when oil prices got to 66 on the WTI side. So I think the problem is the US producers are really not incentivized to increase. The prices are very economical for them. They're making a lot of money last year, but they're just slow to come back to the market. And we're seeing this development. The jury is out as to what they do, but as of right now, looking at the drilling data, it doesn't seem to be much of a pickup. I mean, they'll be slow to come back this year.
Okay, Rustin, just back to you, just on sticking to Europe for now on gas. Again, is there any outlook for the coming summer? First of all, there's a bit of summer demand, I suppose, but also just in terms of the next winter. Yesterday, we had someone on the show who said, 2 months ago, it was like, oh, next winter is going to be the issue. And someone yesterday said, no, this, or even those coming winters, now we're okay in Europe.
Well, I mean, Europe rolls out of the winter this year with high stock levels, higher than what they normally have. You've got a big contango in the gas market to begin with, and you have increased export capacity out of the United States. Now, the Freeport export facility in Corpus Christi is back online, as well as some other new export facilities coming online. You have Germany with their starting up of their new import facilities as well. So net, I think going into this year, I think the gas issue is pretty much a done deal. I don't think there's going to be any real issue outside of a massive cold snap that happens early, which would impact the markets anyway. That's going to stop Europe from having energy security. Now, the other thing is that the EU did extend the gas saving measures that they put in place for 2022, 2023, all the way out into 2024. So they're still also trying to control the consumption of petroleum or natural gas into the energy sector by keeping everybody in that mindset that we still have to ration it, still have to control it. We can't go wholeheartedly. Now, one thing I'd like to point out, Malaya broke up about the SPR buyback. One thing people seem to forget is that the United States government had to balance their budget, was going to liquidate 180 million barrels from the SPR between now and 2030. So they've done that liquidation. I think any talk of a buyback is more political jawboning than actual action. Because if you look at what the plan was under the US budget reconciliation process, they would have been down to 150 million barrels sell down by the end of 2029. And they already went through with the 23 million barrels that they had to do in this fiscal year, despite the fact they've already sold it down, because that was mandated by the US Congress. So any actions to buy back and refill the SPR, I think, is just more political jawboning and not a reality of what's going to happen under the US budgetary process.
Yeah, and I mean, they sort of came earlier than they were planning, and that's just, all well and good. They had to do it, and that was part of the plan anyway. Daniel, back to you. Let's talk a bit about this region and inflation, costs. Any concerns there? I mean, the Gulf, obviously, the economies are doing very well because of the revenue, the energy revenue, but of course, all that is also inflating things. We're getting imported inflation and we're getting local inflation. Any concerns there going forward on any breaks, do you think, in controls that can be put on that? Because of course, obviously we have past and people start to leave and businesses, just can't afford to be here anymore.
Yeah, and there's a high-profile article over a weekend which has generated a lot of discussion, saying essentially that the middle classes are being priced out of Dubai in particular because they can't afford to rent or buy in properties otherwise they might have been able to, or even their groceries are getting more expensive. Obviously inflation has been here to a level we haven't seen. We're enjoying that deflationary environment in Dubai in particular in the run up to a pandemic. That was, of course, on the back of a lower housing prices. They were falling essentially since 2014, and that is now being reversed. Now, house prices aren't quite back at 2014 peaks, relative peaks, but they are getting that way. So for year-on-year price increases, that's 30, 40, 50% in some markets. Whether that's sustainable, well, affordability is declining pretty sharply in terms of a housing market. So you would expect a cap to come in on that. There are some extenuating factors, obviously, the strong population growth we've seen here, especially from some high net worth individuals coming from various points around the world, is feeding through into this, and that does 50% year-on-year rise in luxury prices. That will cascade down through the rest of the market. Higher rental, higher mortgage prices as well have gone up quite significantly. Most people, or most transactions, are cash buyers, but those who are not, that will start to slow that down. So, headline inflation, we forecast 3.5% this year for Dubai. So it's not too painful, but what you have to remember is that those housing prices haven't really fed through into CPI yet. So last year, the key driver was for transport costs. That was at 40% at one point year on year, as those prices at the pump moved in line with the market, and that really drove the headline level. As housing has only really recently, in recent months, started to feed through into a headline CPI figure. That makes up 40% of the CPI basket. So as that starts to feed through to a greater extent, there's always a lag on this, then that headline figure will probably more accurately potentially reflect what people are experiencing. And if you're due to renew your rental, then you might be surprised. So I don't think we've got to the extent yet, or to a level yet, that people might be forced to leave, but people might have to get used to a longer commute than they're used to. Certainly you have the growth of these more kind of like desert communities further out, where you're likely to be spending longer in your car. I think the expectation for those kind of like mid-tier, middle classes, that they are always going to be living those prime areas, will start to fade. I think it is becoming, as well-publicized article said, it is starting to cater a bit more in those areas, at least, not the city as a whole, but in some areas it will be more of a place for substantially wealthier people.
And of course, that those costs filter through to jobs, don't they? And people here and the corporates really then have to pick up by raising salaries. Again, wage trends, which again, I'll go to Maliha on that. Let's just look at the survey question. Do you still subscribe to the dominant oil market demand narrative? That's going to be a year of two halves. So we were talking about that earlier. Are we going to see that pull up in the second year? It seems to me the sentiment is becoming no, increasingly as we progress through the second quarter. But we'll see the result of that. Maliha, on that front, I mean, Daniel was mentioning, inflation here in the region of the Gulf. And of course, we've got also taxation, corporate taxation coming in the Gulf as well, and that will affect company budgets, salaries, etc. Let me go back to you just with that and just talk a little bit about that in from a US point of view. That sort of wage inflation employment figure has been so key to the Fed policy. And then secondly, I'd like to touch on currencies as well, the dollar, and where you see that going. We see it, of course, continue to strengthen last year and then teeter off of it. What's the outlook for that, in the context of the macro policy?
Again, another very pertinent question. So we are basically going to wait for the non-farm payroll data this Friday. If you look back in the last few months, we've seen companies announce massive layoffs, right? We've seen Facebook announce a second round of layoffs, McDonald's, Walmart, every single company right now is laying off workers. So the question is, when does it actually show up in the data? It will show up, it takes a bit of time. The data yesterday on the JOLTS data, I'm not sure if anyone saw that, but basically it predicted the first time the numbers are actually, there are less open jobs per unemployed worker. And I think that's a very negative setback in terms of the labor market is still showing a lot of tightness, but it's moving in the right direction. The Fed needs to see a very weak labor market before it can do anything. So the Fed can only cut if inflation's come back down to 2% or the labor market weakens horribly and they need to do something. But right now they're just waiting, and it takes about probably a few minutes to show up. So we should start to see the payroll data get significantly worse as the months go by. Going back to the dollar right now, the market assumes that the Fed is done raising rates, and I think it's trading more on an interest rate differential basis where they believe that the dollar is going to rally because the Fed's going to pivot at some point, and that's very dovish. And that dovishness is feeding through across all cross currencies right now. We don't think it's that simple because the Fed may be holding the rates higher for longer. Everybody talks about a pivot, but nobody actually talks about what if rates stay here. When I started my career many, many years ago, we were trading at 4.5%, 5% neutral rate. So this whole idea of pivoting and cutting doesn't really need to be in a normal cycle. And I think that's something the market's not pricing in, and that would be dollar bullish. So I don't think it's over for the dollar rally yet, but the market perception very much is that the Fed's going to save the day and the dollar will fall, which is why we're seeing everything rally. All the risk assets are rallying on back of that.
Okay, Rustin, just back to OPEC or producers and the supply of oil. We've had Iraq and Kuwait, some headlines the last few weeks that's coming back into the market more than it was available before, particularly Iraq, Kuwait increasing production. What's the feeling there from the market point of view of increased OPEC supply that's been in the planning for a while? And is there optimism that that's going to be available? And Libya, we could put into that mix.
Well, I mean, first off, when you look at OPEC Plus, they've been producing well below quota, probably ever since they established these quotas. They have never achieved as a group the quota level that they've set. So part of the reason why the markets, I think, had a more tepid response, yes, they rallied 8% initially, but came off, is that when you actually look at the quota level versus actual production exports, they were still about 1.6 million barrels below their actual production, actual quota levels. So this cut has basically brought the reality down to their actual production levels for OPEC. Now, in real terms, this cut that they've announced is probably 800,000 barrels, because when you look at the people who are cutting from Saudi Arabia, Kuwait, and UAE, they were producing right near or close to their quota levels. Therefore, they're actually reducing the amount of oil they're supplying to the market. Everybody else was well below. So it's kind of like, yes, we'll announce a cut, but they're just more bringing their quota levels in line with the reality of their own production. So if anything, this cut establishes a far larger spare capacity because the three main producers are reducing their exports. I think other countries are still going to be producing higher. And then you have a lot of non-OPEC production that's increasing. I mean, if you look at Ghana, you look at what's going on in the North Sea with Norway, even in the US Gulf Coast, even in other South American countries, there's a lot more crude that's going to be coming online between now and the end of the year that, should offset a lot of what OPEC does, and then starts questioning, yes, OPEC is 29 million barrels a day of oil supply to the market, but with all these other supplies coming in, it just diminishes their pull on the market because you have a lot more larger fields that are being developed, being brought up. So I think there's going to be a bit balancing that's going to happen when you look at the actual supply of crude versus OPEC's percentage of that supply.
And have we seen any evidence of Russia's unilateral announcement last month of its 500,000? And where's the Russian picture going forward, do you think, this year? And will sanctions bite more into its production capability or not?
From a shipping perspective, I haven't seen anything yet to show me that there's been a cut in Russian exports. That's on products as well as crude oil. Does that mean that it's just kind of a lag effect where we might start seeing those cuts happen here in April? Or start translating them onto the market potentially, but when you look at the data of what's been nominated to ship out of Ust-Luga and out of the Black Sea, it actually looks like a month-on-month increase for products, for gas oil and for fuel oil coming out of those regions. So I think it's just more talk than action as of right now.
Okay. Daniel, in terms of oil price trajectory, we still have a couple of banks, Goldman Sachs and others, being very bullish on, oh yes, we will see $100 oil again this year, for example. Do you think that's even a possibility, or will OPEC, keep that in check, even if we see that demand come through and we have supply issues or tight supply? Are we going to, is OPEC, which is in control at the end of the day now, the market, we can all acknowledge, going to keep that in check? Or do you think the Gulf economies would let that happen?
Yeah, I mean, we were one of the houses with a pretty bullish view. We had a forecast of 105 until not long ago, but essentially we marked to market when we had the fallout from SVB and the rest of it, and we revised that down pretty substantially to an average of 88. The expectation was still that we would see pretty sharp market tightness in the second half of the year, and this, and that was prior to what we had the news over a weekend. So we still expect an average in H2 of somewhere from around 93 to and above dollars a barrel. Whether we'll get back to 100 might not quite happen, but certainly, like, our view is still the expectation is that tightness will be there, and we'd expect that OPEC Plus, especially these key members, would look to maintain that, or at least Saudi Arabia in particular. And I think there would be some expectation that the others would follow.
Okay, and on that front, on the OPEC moves, a lot of commentators this week, when they did announced that cut, were saying, yes, of course, it's to give prices support short term, but actually it was just another geopolitical play of them sort of asserting their independence in their oil policy, and that they will not be, told what to do by the US, as they demonstrated already last year. Is that becoming sort of the new norm, and has been fully asserted that OPEC and the Gulf are now looking, they're looking eastwards? That's their focus. That's all they care about. They will need to protect their consumers to an extent on price, but that the US really doesn't have a say anymore.
Right. I mean, the media has been very good about pointing out how the alliances are slowly changing. We're going back, many, many years. It'll take a long time. But we think the OPEC region, Saudi Arabia, they're keeping their options open and looking toward a new partner, but they're not going to let go of the old. It's not going to be that simple, but they are keeping their options open. The oil price is very, very important for them because you have to remember the budget spending for is about $85 to $90 a barrel, given their future ambitions and aspirations, diversifying into an economy that's non-energy related. So prices are very important for them. They have to fund their future ambitions. So the price of 75 or 80 is where we sort of assume there's a floor for them. But as we said, if we do get a very harsh recession, right now OPEC is a swing producer. They can manipulate the market if they like. I mean, they talk about how they want to squeeze the shorts out, as they say, vocally on media. But if you go into a very harsh recession, that rate of change, they may lose their power. Just like the Fed may lose control of the market, it is possible that we get a much worse recession and OPEC cut may actually work against them. But in theory, you are right. They're looking to support that because they need to keep stable revenues for the future ambition plans.
Okay, and we saw the survey response come up earlier, above 60% still think that we will see that second half pull up in demand, and therefore we are going to see a tighter market. So, well, it's 11:01. I'm afraid we've run out of time. I'd like to thank Maliha Bengali, Rustin Edwards and Daniel Richards for joining us today. We have our halftime talk feature interview coming up in the next hour with Guy Mason, who is formerly with BP Shipping and is now a chairman of the International Foundation for Aid to Navigation. An interesting interview there that I had with Guy on navigation aids, but really about the shipping sector and how it's managing with these new energy flows and his points of view as to how disruptive that's been. One headline there is that the shipping sector those flows will continue to adjust, and the shipping sector is very capable of adjusting with that. So thanks very much everyone for joining us, and have a good Wednesday.
Thank you.
All the